Welcome to Iron Financial, the place where we forge stronger portfolios by cutting right through market weakness. Today, we are putting a fallen giant on the anvil. We're talking about Genuine Parts Company, a nameplate in American industry for, nearly a century? Well, it just had a catastrophic day on the market. The stock got absolutely taken out behind the woodshed. And while most investors are running for the exits, we're running in. We're here to see if the foundation is cracked beyond repair, or if this is just the necessary demolition before a much more profitable rebuild. Just look at this. This is pure carnage. So the stock closed the day at over $147. Everything seems fine. Then, boom, the earnings report drops. Before the market even had a chance to open for trading, the bids just evaporated, and the stock was in a 7% free fall, touching down below $137. This, right here, is the kind of shockwave that shatters portfolios. It tests the conviction of even the most hardened investors. It is a violent, immediate repricing of a company's entire future. And the question is the market's verdict correct? Okay, I see the blood in the water, the herd is spooked, and a big legacy name gets hammered. You know, it's a classic story. So the question that's on my mind, and I'm sure on everyone else's watching this, is why are we spending our time sifting through this wreckage? I mean, aren't we always told to never ever try and catch a falling knife? Is there really something of value left here? Or is this just a classic trap for bargain hunters who think they're smarter than the rest of the market? That is the central question, and it's exactly what we're here to answer. We don't run from volatility, we run towards it, and we analyze it. And we have a clear blueprint for our analysis today. First, we're going to examine the company itself and that initial crack in its armor. Then, we are going to drill down deep into the demolition data from that disastrous Q4 report. After that, we'll analyze management's pretty radical rebuild plan, a plan they announced on the very same day, believe it or not. Then we'll stress test the company's underlying foundation to see if there are any hidden strengths. And of course, we'll end with a clear verdict. Is this an opportunity or is it a trap? All right, let's lay the foundation here. First, you have to understand what Genuine Parts Company, GPC, really is. This isn't some high-flying, no-earnings tech stock that lives and dies on hype. We are talking about a company established way back in 1928. It's a massive global distributor of automotive and industrial parts. For most people, the name that immediately comes to mind is Napa Auto Parts. This is supposed to be a stable, bedrock company that you can build a portfolio on for the long haul. It is the very definition of an industrial stalwart, and that's exactly what makes this crack so jarring. Okay, time to get our hands dirty. This is where the demolition crew really came in. The fourth quarter earnings report wasn't just bad, it was an unmitigated disaster. And forget the excuses for a second. We're going to look at 3 specific numbers, just 3 data points that tell you everything you need to know about the scale of the damage and exactly why the market reacted with such violence. First up, the bottom line. This is the number that ultimately drives stock prices, earnings per share. Now, Wall Street analysts, the so-called experts, they had built all their models, crunched their numbers, and their consensus estimate was for $1.81 per share. GPC came in and delivered just $1.55. That is a 14.4% miss. Now, in the world of large-cap industrial companies, that's not just a crack in profitability, that's a chasm. It signals a fundamental breakdown in the company's ability to forecast its own business and deliver. But this next number is even more shocking. We're talking about adjusted EBITDA. For those of you who aren't familiar, just think of this as the raw core earnings power of the business, before all the accounting tricks and noise. It's the horsepower of the company's engine. The street was expecting a healthy $504 million. GPC reported just $145 million. That is a staggering, mind-blowing 71.2% miss. It's almost unbelievable. The engine has completely seized up. This isn't just a tune-up issue. This points to a massive mechanical failure somewhere deep, deep inside the business. And if you thought, okay, maybe the bad news was just contained to the past, well, you'd be wrong. Management then provided their guidance for the future for the entire full year of 2026. Their forecast, right at the midpoint of their range, is a full 8% below what analysts were already projecting. So they're not just saying, hey, we had a bad quarter, but things are turning around. No. They are actively telling the market that the pain isn't over and that the recovery is going to be much weaker than anyone thought. They basically poured gasoline right on the fire. Okay, wait, let's just pause on this table. These numbers, they're absolutely brutal. I mean, the revenue miss is small, just under 1%, but the profitability misses they're catastrophic. How does a company this big, this established, miss its core earnings target by over 70%? Was management completely asleep at the wheel? Did they have absolutely no idea this was coming? It just screams incompetence. Yeah, and that is absolutely the right question to ask. Now, management does have an explanation, but you're going to have to decide for yourself if it's a reason or if it's just an excuse. They point to a massive non-recurring charge, specifically a $160 million hit they had to take. This was related to expected credit losses from a key vendor, a company called First Brands, which filed for Chapter 11 bankruptcy. Okay, that accounts for a huge chunk of that EBITDA collapse. But here's the key. Even if you strip out that entire $160 million hit, their earnings would still have missed expectations. And it certainly doesn't excuse the weak guidance for the next year, and it doesn't excuse the top-line revenue miss either. The structure is compromised with or without that one-time event. But here is where the story takes a really dramatic turn. On the very same day that they reported all this carnage, in the very same press release, they announced a radical plan, a complete overhaul of the entire corporate structure. It's like they handed the market a blueprint for a total rebuild, almost as if to say, hey, don't look at the fire over there, look at this shiny new building we're about to construct instead. A split? You're telling me that on the morning of a massive 71% earnings miss, they also announced they're breaking the entire company in two? That timing sounds, I don't know, desperate. Is this a real, well-thought-out strategy to unlock value for shareholders, or are they just shuffling the deck chairs on the Titanic to distract investors from the iceberg they just slammed into? It feels like a magic trick, look over here, to get everyone to look away from the terrible numbers. It's a valid question, and the timing is certainly aggressive. I'll give you that. But let's actually look at the plan itself. The mechanism they're using is a tax-free spin-off, and they're targeting completion for the first quarter of 2027. So what this means is that GPC will be split into two separate publicly traded companies. If you're a GPC shareholder today, you'll end up owning shares in both of these new entities. The logic, at least what they're telling us, is that this will unlock value by creating two more focused, more agile businesses that the market can value independently and, they hope, much more richly. So here's the before and after laid out right here. Today, you own one giant, complex machine, a conglomerate that's trying to serve two very different markets, automotive and industrial. After the split, you'll own two smaller, high-performance engines. One is purely automotive, the other purely industrial. The whole idea is you eliminate that blurred focus, you get tailored strategies for each business, and capital can be allocated way more efficiently. So let's pop the hood and look at the specs for each of these new machines. First, you've got the global automotive business. This is the Napa brand that everybody knows and loves. And make no mistake, it is no small player. We're talking about a company that on its own would have over $15 billion in sales and $1.2 billion in EBITDA. It's a behemoth. And it's operating in a massive, fragmented $200 billion addressable market. That gives it a huge runway for growth, especially with those commercial, do-it-for-me customers. This is a pure play bet on the global auto aftermarket. Now this is what I think is the hidden gem in the entire portfolio. The second piece is global industrial, which operates under the Motion brand. This is an incredible business. We're looking at roughly $9 billion in sales and over $1.1 billion in EBITDA with very, very strong margins. They provide mission-critical industrial solutions. And think beyond just basic parts here. Think automation, robotics, fluid power, and the build-out of AI infrastructure. This business is plugged directly into major secular tailwinds. It is a high-quality industrial leader that, for years, has been overshadowed by the larger auto business. Okay, I'll admit it, the plan does look good on paper. You create two focused companies, each one a leader in its market. You really can't argue with that logic. But a blueprint is just a piece of paper. The plan won't even be complete until early 2027. That is a long time to wait around while the core business is still showing these major signs of weakness. So the real question is whether the underlying materials, the company's actual financial health, are strong enough to even support this rebuild, or if the whole thing's going to collapse before they can even get started. Exactly. And that is precisely the right question to be asking. Before we can trust the blueprint, we have to stress test the existing foundation. We've seen the cracks, we've seen the damage from the Q4 report, but now let's look for the steel girders that are holding this whole thing together. Because despite the recent damage, GPC has some core structural strengths that the market might be completely overlooking in its panic. First, let's talk about who owns this company. Look at this. Nearly 79% of Genuine Parts Company is owned by institutions and hedge funds. This is what we call the smart money. These are large, sophisticated investors with entire teams of analysts. Now, while some of them might be trimming their positions after a report like this, such a high level of ownership suggests they see some deep, long-term structural value here. They are not all hitting the panic button and running for the door. They see a solid foundation underneath all that rubble.
And then there's this number, 70. 70 straight years of dividend increases. And get this, in the very same announcement as the disastrous earnings and the radical split, they announced another 3.2% dividend hike. Just think about the confidence that signals. This is a testament to the powerful, consistent, long-term cash flow generation of this business. A company cannot fake this for 7 decades. It is the definition of a financial bedrock, a source of strength that you can absolutely build on.
Okay, I have to give you that. 70 years of dividend hikes is a serious track record of durability. You just can't ignore that. And you're right, the institutions haven't completely abandoned ship. But let's be real about the analysts. This table shows they're pretty mixed. They call it a moderate buy, which, is basically Wall Street code for we have no idea. And that average price target of over $154 is still miles above where the stock is actually trading after the drop. It feels like they're just weighing this 70 years of history against the current disaster and, splitting the difference. It's not exactly a ringing endorsement, is it?
That's exactly what we have to do now. It all comes down to this final assessment. We've seen the demolition in the Q4 numbers, we've analyzed the blueprint for the rebuild, and we stress-tested the foundation. So now we put it all together and we weigh the evidence. Let's lay out the final case, the bull versus the bear.
The bear case is simple, and it's powerful. It argues that this company is fundamentally broken. The disastrous Q4 earnings and that weak 2026 guidance, they aren't a blip. They are symptoms of a deep operational rot. The stock is a classic falling knife, and the plan to split the company? It's nothing more than a desperate act of financial engineering to distract you from the core problems. Buying now, the bears would say, is just walking straight into a value trap. But the bull case argues that the market is just panicking and completely overreacting. They're pricing in all of the demolition, but they are totally ignoring the long-term value of the rebuild. The bull thesis is that the earnings miss was painful, sure, but it was heavily amplified by a one-off bankruptcy charge. And more importantly, the split is a brilliant strategic move that is going to unlock significant value by creating 2 best-in-class pure-play leaders that are just easier for the market to understand and value properly. And that 70-year dividend history? It proves this business is a survivor with a rock-solid cash flow engine. The bulls see this as a rare opportunity to buy a quality asset when it's just temporarily covered in dust. So where do we land at Iron Financial? For me, the strategic rationale for the split is incredibly sound. It's a move they probably should have made years ago. Creating 2 focused companies, especially unleashing that high-margin industrial business, creates a clear and tangible path to long-term value creation. I believe this path outweighs the short-term operational damage we saw in Q4. The market is focused on the last 3 months. The smart investor should be focused on the next 3 years. The blueprint is solid. I'll concede, the blueprint is very compelling. And that dividend history combined with the high institutional ownership, that provides a margin of safety that you just don't see in most falling knife stocks. But my caution remains on the execution. The rebuild isn't happening tomorrow. It's still a year away. Management has to navigate a tough environment while also orchestrating this incredibly complex corporate separation. The execution risk is high, and investors are going to need patience. This is not a quick fix. Agreed, this is not a trade for the impatient. The verdict from us is this. Genuine Parts Company presents a compelling, long-term opportunity. The sell-off appears to be an overreaction to short-term news, ignoring a credible, value-unlocking strategic plan. For patient investors who can withstand the short-term volatility and the headlines, this looks like a chance to buy into a quality industrial and a quality automotive business at a price that reflects demolition, not reconstruction. It's an opportunity, but it's definitely a trap for the unprepared. This is a long-term build.
Ultimately, you have to decide what you see when you look at GPC today. Do you see the wreckage of one bad quarter, or do you see the foundation of 2 new, stronger companies being laid? Is the market correctly pricing in all the risk, or is it just blinded by the demolition dust, unable to see the finished skyscraper on the other side? That's our analysis. The decision is yours.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.